the U.S. government reported that for the month of August alone, the fiscal deficit was $380 billion. That was, hell, for me, it was like, what? In a month? $380 billion? And I think that kind of, if you're a fiduciary managing retail money, hedge fund money, whatever, that was kind of a shaky by the lapels moment. Like, wait a second, this is really getting out of control. And gold has moved up about $150, $200 since then. I think, so I kind of got this combination of factors that just keeps putting a bid under gold and keeps moving higher without a sustained pullback.
Gold remains strongly supported amid concerns over the growing U.S. deficit, which appears to increase regardless of the upcoming U.S. presidential election outcome. The recent surge in gold prices, which reached a record high of over $2,700 per ounce last week, marking a 40% increase over the past year, has intensified questions about the future stability of the dollar-based international monetary system. This rally in gold suggests that investors are increasingly seeking safe haven assets as confidence in U.S. fiscal policy and dollar strength face potential long-term challenges. Craig Hemke from the TF Metals Report discusses the staggering growth of U.S. debt and its correlation with rising gold prices. Hemke explained that given these financial conditions, many would have anticipated a challenging start for gold in 2024. Surprisingly, gold defied expectations by gaining momentum, particularly after breaking out of a 3.5-year range on March 1st. This breakout signaled a renewed interest in gold as a safe haven asset as concerns over U.S. debt levels and fiscal stability continued to intensify. The federal government's budget deficit reached over $1.8 trillion for the fiscal year 2024, which ended in September. This marks the third largest deficit in U.S. history, exceeded only by the fiscal year 2020 and fiscal year 2021 deficits driven by elevated federal spending due to the COVID-19 pandemic and related economic challenges. Looking forward, deficits are expected to keep climbing. The Nonpartisan Congressional Budget Office, CBO, projects that annual deficits will exceed $2 trillion starting in fiscal year 2030, reaching nearly $2.9 trillion by fiscal year 2034. Since the August report, gold prices have risen by approximately $150 and $200. Craig Hemke identifies a combination of strong central bank demand and the U.S. fiscal situation as key factors sustaining gold's upward momentum with minimal pullback. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
When the year got underway, going all the way back to January, I thought, by the time we get around to the Fed actually cutting rates, we'll probably have gone sideways for about the first 6 months of the year, and then we'll finally break out. We'll go to about 2,300, and that's maybe about the best we could expect, because as we entered the year, the talk was, the Fed's going to cut 6 or 7 times, and the dollar index was down around 100, and had you known then that those rate cut expectations were going to get trimmed back to basically zero by June or July, that the yield on the 10-year note was going to go up 50 basis points, that the dollar index was going to go up by 5 or 6%, you'd have thought, oh man, boy, we're in for a tough start to the year. And instead, gold takes off. I'm first to admit, I was pleasantly surprised by that. Once it actually broke out of its 3.5-year range back on March the 1st, it was just off to the races. And then eventually the attention turned to silver and why isn't silver moving to catch up? And then silver moved to catch up. Gold then goes sideways through the summertime, then breaks out again. And so we've been waiting for silver to break out again. That has happened as well. So it's been a very exciting year. What ultimately, though, is driving it is really hard to put your finger on. I think central bank gold demand is obviously a big driver, because this is going to be the third year in a row of record central bank demand for physical gold. And you can certainly see this across, whatever you want to call it, the developing nations, the BRICS, the global south, whatever. You can definitely see every month, India, Turkey, just go down the list, they're constantly adding gold. But I think we're starting now to get enough headlines, that people are paying attention to gold in the first, that, wow, look at that gold go. I wonder what's going on. But then you get news like the fiscal situation here in the U.S., Patrick. And I think this was an underappreciated moment about 6 weeks ago. The U.S. Treasury Department is supposed to, at least, on the 8th business day of every month, report the previous month's deficit numbers or surplus numbers, or how much income they took in through taxes and fees and how much they spent. Okay, 8th day of every month that's supposed to come out, 8th business day. Well, that turned out to be, for the month of August, that was like September the 9th or 10th or something like that. And that day, the U.S. government reported that for the month of August alone, the fiscal deficit was $380 billion. That was, hell, for me, it was like, what? In a month? $380 billion? And I think that kind of, if you're a fiduciary managing retail money, hedge fund money, whatever, that was kind of a shaky by the lapels moment. Like, wait a second, this is really getting out of control. And gold has moved up about $150, $200 since then. And I think, so I kind of got this combination of factors that just keeps putting a bid under gold and keeps moving higher without a sustained pullback.
Even in discussions about diminishing the dollar's dominance in international trade, a goal generally supported by most BRICS member states, there are significant differences in approach. The anticipated rise of China's renminbi as an alternative to the dollar, for instance, has raised concerns among other members, particularly India, which may prefer a more balanced multipolar currency system. The BRICS group collectively criticizes the Western countries' use of sanctions and seeks to promote the use of local currencies for financial transactions among member states. This move aims to reduce their dependence on the US dollar, fostering a more independent economic environment and enhancing intra-group trade without the constraints imposed by dollar reliance. Craig Hemke explains that after World War II, the United States held a stable economy and vast gold reserves, approximately 25,000 tons, which positioned the dollar as the logical global reserve currency, fully backed by gold at $35 per ounce. This arrangement provided global confidence, allowing dollars to be exchanged for gold, which helped fuel the post-war economic boom of the 1950s and supported the success of the Marshall Plan. Now, let's redirect our attention to a video.
At a time when the dollar was still convertible into gold, right? You could show up and have $35 and get an ounce of gold. After, this kind of goes back, got to give everybody a little history lesson. But after the destruction of World War II, there were no functional currencies that could be used, in global trade, except the U.S. The U.S. had a functioning economy because, we were separated, from everything by the oceans. And we had all the gold. We had 25,000 tons of gold. And so to restart the global economy, the U.S. dollar was made the global reserve currency, and every dollar was backed by gold. You could exchange it. You could accumulate dollars. You could swap it. And it gave everybody confidence in using it, that it had value. And, you had this great boom in the Marshall Plan and, the great boom in the 50s and all this kind of stuff. Well, the problem is by the late 50s, short, even 10 years later, in their foreign currency reserves, countries had accumulated dollars. They export whatever to the U.S. They get dollars back. Now they got these dollars. What are we going to do with them? And they started wanting their gold. And by like 1958, the U.S. had already lost a third of its gold reserves through that, people showing up and wanting. And this was a massive scandal. You think of the 1950s, Richie and Ponzi and Fonzie and everybody else having a good time. This was a huge scandal. All right, what are we going to do? How are we going to, and again, it was all in support of that $35 price. Well, by 1961, the U.S. decided, well, we'll work with 7 other of our allies. We'll all pledge physical gold to defend that price in London. And so if, price got up to $37, they'd dump some physical gold onto the market. Price would go down to 33, they'd buy it back with the idea of it always kind of staying within this region of 30. Well, the problem is wars, the Great Society, everything else prompted the U.S. to just keep needing to create dollars. And more and more dollars came in. And all of a sudden, there wasn't enough physical gold left in London to satisfy at that price. And so the gold pool collapsed. So now the U.S. is back on their own. 3 years later, Nixon looks around and goes, man, if we don't suspend this convertibility into gold, we're not going to have any left. And that's the origin of what happened. When you are trying to defend a price with physical, there's just only so much of it around. And this imbalance It's like rent control, that sort of thing. Anytime you try to falsely defend a price, eventually you just get overwhelmed because of the demand. I mean, the laws of economics are always going to apply. And that's what killed the London gold pool. And that eventually is what's going to kill let's call it the London, New York derivative pool. Because you've got to have physical metal. You've got to be able to settle physical trades at your derivative price to give your derivative price any significance. I mean, you could sit there and say, yeah, well, look, on the COMEX, gold is $1,500. But if there's people lining up to buy it at $1,500 and you don't have any at $1,500, the price ain't $1,500. So the two have to kind of reflect each other. You've got to deliver metal at that price, however you derive it.
The rising U.S. deficit and debt levels are strongly supporting gold prices, as they highlight growing concerns over economic stability and the strength of the dollar. With record-high deficits and increasing government borrowing, investors are turning to gold as a hedge against inflation and potential currency devaluation. As debt projections indicate continued fiscal strain, the demand for gold has surged, driven by fears of diminished dollar value and long-term financial risks. This combination of factors is creating strong upward pressure on gold prices as more investors seek it as a safe haven asset amidst economic uncertainties. With the current economic landscape, is investing in gold more crucial than ever? Share your feedback in the comments below. If you found this video useful, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.